Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Barb Armstrong. She's there to help facilitate the conversation and keep that going. Welcome to all of you, whether you are here for the first time or for the 100th time. We're glad to have you with us. And also whether you are here in the live version or in the recorded session, we're glad to have you be a part of the conversation. Chat in your questions, leave your comments for us in the recorded version, if you will, and we will respond to those as best we can. I wanted to talk a little bit. It's been a couple of weeks. We had a live event, then I was out for some vacation time, and it's been a couple of weeks since I've been in this particular webcast. So I want to catch up a little bit. I kind of left it to sit in this account. So I wanted to catch up on our 14-7 strategy really quickly, number one. And then number two, I have a couple of ideas that are a follow-up to a discussion that Brent Moores, one of our great education coaches, had earlier today in his Managing an Options Portfolio webcast. And he talked at great length about the idea of beta weighting your portfolio to a particular metric, whether it's the SPX or whether it's to another index, whether it's to another stock, whatever it might be, to assess the exposure that your portfolio might have to that risk of a particular instrument moving. The reason that this is important is because index options are oftentimes used as the hedging instrument when beta weighting to offset that potential exposure. So I wanted to talk about a couple of different ways that we could do that in this discussion that are a continuation of the conversation that Brent was having. So some of you were there earlier this morning. If not, I'm going to ask Barb to do me a favor and find the link to Brent's webcast, his Managing an Option Portfolio webcast, and have her post that out there in the chat. So let's get started here. A couple of quick housekeeping items that we need to take care of. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice. Remember that if we look at specific symbols, those are for illustrative purposes only. Investing involves risk, including loss of principal, past performance, no guarantee of future results. Now, when trading equity and index options, they carry a high level of risk. They are not suitable for all investors. Make sure that you understand and have read the option disclosure document titled Characteristics and Risks of Standardized Options before considering any option transaction. Now, hedging strategies, protective strategies, generally are going to involve additional costs. They don't assure a profit. They don't even guarantee against loss. So I just want to keep that out there in this discussion. Now, one of the reasons, we talked a couple of weeks ago about the reasons that some traders may trade index options as opposed to other options. Generally, the index options that we will talk about are European style indexes, and those European style indexes do not allow for early assignment. So that takes away that early assignment risk. But anytime that you're trading an American style option, and there are some indexes out there that are American style, anytime that you're trading an American style option, there is the possibility that a short option could be assigned early prior to expiration. So just be aware of that. Also, when we're trading options near expiration, make sure that you consider the risks to that strategy include of lack of liquidity. We demonstrated a couple of weeks ago the difficulty in getting out of a trade on a 0 DTE example close to expiration, close to the end of the day, where it just we could not get that order filled. So that is a consideration as well. Remember also, when we talk about stops, we talk about technical analysis, we talk about all these things, there's no guarantees out there in the market. You know, technical analysis doesn't guarantee price movement. Stops do not guarantee a fill price, just an execution price, or excuse me, an activation price. In the event of a stop limit order, that stop limit order may be gapped around and that order may not even fill. Also, we're going to be using the Thinkorswim desktop software platform. The Paper Money platform is a great learning environment. It is not, however, a guarantee of future success out there in the real world. So just keep that in mind. Barb, the webcast was in Managing an Options Portfolio today. So it might be out there in that list. Also, you can follow me and Barb on X at Ben Watson CS, at Barb Armstrong CS. Let's pop over here to the Thinkorswim platform and just kind of see what's going on in the indexes here. Taking a look at the SPX at the moment, a little bit of an update. We've kind of had this sideways performance going on. I talked a little bit about this yesterday, but we're kind of going up and down here. And a little bit of a bullish engulfing candle today. So some bullishness, the SPX, the RSI moving a little bit higher here. So the SPX index moving a little bit higher. The NASDAQ doing something similar, kind of coming back. Maybe a little bit of a bullish engulfing candle today, although not a huge engulfing, but it is kind of moving around there and getting a little bit of an uplift. And then the Russell 2000 giving us that bull flag type of perspective here, coming up off of the, in this case, 50 period simple moving average, giving us kind of that bullishness. Now, nevertheless, we look at this market and you look at the trend of all three of these indexes, and we're coming into a situation where we're really kind of making, at the moment at the least, a roughly equal high. And I talked yesterday about, in a webcast that I taught for Barb, which was getting started with technical analysis. I talked about the idea of being able to identify highs and lows. And at the moment, we're really kind of making equal highs and a lower low in the context of this intermediate term trend. So what does that mean for us? Well, we're still poised to potentially move lower. Doesn't mean that we're bearish. It doesn't mean necessarily that, that this market is crashing or anything else. It just means that there is that possibility that the market makes a move lower. There's still a lot of volatile data points. We've got a Fed meeting coming up. We've got the end of the year, which can be a Santa Claus rally, but the Grinch could also take over. So you've got a lot of things that maybe are weighing on portfolios, which is one of the reasons why I wanted to talk about the idea of using indexes as a means to hedge our maybe a long stock portfolio. The other index that I wanted to look at here really quickly was the VIX index, and we talk about this quite a bit. Here's the VIX at the moment, and I'm going to zoom over here on the right hand side. And the VIX at the moment is kind of sitting down around this 1590 mark, kind of in the top edge of the 15 handle, with the potential to move higher. And we've seen it move higher, significantly higher. In fact, it's well below at the moment its moving average, its 30-period moving average, is sitting right about the 1877 mark. So if there were some downside movement in the indexes, it's also very likely that we would see upside movement in the VIX. So I wanted to bring that into the equation as well, talking about that rise in volatility and maybe how we can use an index option to take advantage of that potential rise in volatility, and specifically in the VIX index. So let's talk a little bit about, first of all, managing our 14-7 strategy, because I think that's kind of the core of what we have been discussing in this webcast on an ongoing basis. And so I want to go back over here to the grid that I want to change this to, which is my index. Let's see where that is. Index options grid. It's right there. Index options grid. So on this grid, we've got the SPX. You could use this grid for any index. You could use it for any instrument. But we're specifically using this for the SPX for this 14-7 strategy. And you can see that I've drawn these marks on the SPX corresponding with where we have sold each individual vertical spread in this strategy. Now, for some of you who are just joining us, this strategy is a fairly simple and straightforward strategy. The idea is, at 14 days to go until expiration, we sell a short vertical spread. We either sell a short call vertical spread or a short put vertical spread. If the S&P 500 is above the moving average, in this case, let me just go to the max myself. If the SPX is above the 200 period moving average, we are selling put spreads, taking a look at that possible upward movement. If the SPX is below the 200 period moving average, then we sell call spreads. Hasn't been below the 200 period moving average since May. So we've been selling put spreads all along. This range right here, we've been selling put spreads. So we're going to do the same thing since we're still above the 200 period moving average. So what I'm going to do is I'm going to come back to my trade tab for the SPX. We'll bring up the SPX. And the reason we're doing this on the SPX, there are other instruments that we could use to do this with, but the SPX is perhaps one of the more liquid, just from the standpoint of its activity as an institutional product. But we're going to go to the 17 December expiration, which is 14 days to go until expiration. So that's the date that we are going to choose to sell. That's the expiration date that we're going to choose to sell here. So what I'm going to do is I'm going to go back to the chart, knowing that that's the 14th. And I'm going to come over here to the grid that I have, which is the next one over. This is the 1 year daily chart. But if I bump this over one more grid, I've got two charts side by side. Now this is a 3-month 1 day chart. It's giving me the same information, it's just condensed format. And it's also telling me where implied volatility is. Implied volatility is relatively low. So what I'm going to do is I'm going to take this timeline right here, this time level, and that's one of our drawing tools here in the drawing tools tab. And it's right down here where it has that little clock and the vertical line. That's our time level. I'm going to right click on it. I'm just going to activate it. And we're going to drag it over to the 17th of December. There's the 17th of December. And we're going to put that line in place at the 17th of December. Now, the next thing that we're going to do is I'm going to draw a little intersection right here at 6650. That's just about the level where that is intersecting, where that time hack is intersecting that one standard deviation probability curve. Now, several people have asked me the question, why one standard deviation? Well, one standard deviation from a statistical standpoint incorporates the majority of the movement that whatever the data is expected to fall within that time frame. So the likelihood is that the price of this index is going to be somewhere inside this curve in that time frame. If it's outside of that curve, it's making a bigger move, a more volatile move. So we're playing the probabilities here in this trade. That's why we're using that one standard deviation. So that level at this point is 66.50. That's the strike price for the put spread that we're going to sell. That's going to be the short leg. Now, that's how we kind of structure this trade. Now, I happen to notice really quickly that there is a feedback survey out there in the chat. I would love it if you would help us out and be a part of this conversation by helping us fill out that feedback survey. Let us know what you think of this webcast. And we read every single one of those comments. We take them to heart and we use them as a means to make these webcasts better. So here's our 14 days out. We know where our short strike is going to be. It's at the 66.50. Implied volatility relatively low, so we're not going to get as much premium here as we have in other times. We talked about the VIX being low, so it's very likely that we're going to get maybe, I'm going to say maybe $1.70 out of this premium, and I'll show you what we do. We're going to go over here to the trade tab once again. We're going to go to the 17 December expiration, and I've got to add some strike prices here so that we can get out to that 66.50 strike. Here's our 66.50. And what we're going to do is we're going to make this a 20-point wide vertical spread. And every time I do this, somebody asks, why are we going 20 points wide? We can go 10 points wide. We can go 40 points wide. You can go 50 points wide. What changes is the amount of risk and the aggressiveness and the performance of the spread, the cost of the spread, the amount that we're going to get. So if we go 66.50 and we sell that 66.50 put, that's the starting point. And then I'm going to go to the 66.30 and I'm going to buy the 66.30 put. Now we've created a vertical spread. We're getting $2. I'm surprised. So what that tells me is that maybe there's a little bit more inflated implied volatility here in this particular expiration, other than the fact that maybe it falls right after the Fed meeting. That might be one of the reasons why. So we're getting theoretically $2 for this spread. But if we click on confirm and send and we look through this the numbers here, $200 potential maximum profit on the trade against a theoretical max loss of $1,800. Okay, $1,800. Now, here's the thing. You think, wow, that's not a great reward to risk potential here. Making 200, risking 1,800 to make 200? Yeah, but, and I don't say yeah, but very often. I say yes, and, because, that kind of keeps the conversation going. Yes, and we may have the potential to make 200, which is highly probable, and we have the possibility of losing 1,800, which is less probable. Still a possibility, but less probable. We need to see a big move outside that one standard deviation range in order to take that max theoretical loss. And we're looking at taking this trade off at 7 days to go until expiration, come what may. So we're not holding this all the way till expiration. So that shifts the probabilities a little bit more in our favor as well. So I'm going to put this in our index options weekly group, and we're going to fire this order off. But before we do that, before I fire this order off, I just want to go back and I want to just double check something, because I think I may very well have just left this vertical spread in place. So this is the last one we sold, and I sold this one back on the 19th of November, which was the last time that I taught this particular webcast. So that's just kind of hanging out there. It is at a 0 days till expiration. It's at its last day of its lifespan. That was 14 days ago. And you see that it's at a zero bid at the moment. It's 25 or 0.2 cents by 0.2 cents. It's very likely that this is going to expire worthless, because I just kind of let this sit. I did not do anything with this while I was on vacation. I apologize. I was at Disneyland, and, I got distracted. So we're going to close this one down positively first, if we can. There may not be a way to exit out of this position since it is zero bid. We're going to bump this up a little bit. We're going to be willing to pay a nickel to close this out, buy it back for a nickel and avoid the pickle. Click on confirm and send, read through the order, fire that order off, and let's see if we can close that out. That order may not fill. It may just simply expire worthless. But that's one of the reasons why we don't hold these all the way till expiration in this strategy example, because there is a potential that we might find some difficulty in exiting the position close to expiration. Yes, I could leave it out and let it expire worthless, but I'm still faced with the potential risk in this trade. What if the SPX, albeit very, very unlikely, what if the SPX were to make a big move on some sort of weird news announcement here at the end of the day and just collapsed? Then there's the possibility, right? Then there is the possibility that I could take some loss in the trade. Right now, we've taken our max theoretical gain in the trade. All right, let's go back to our trade tab and let's pop that order back up. And here, you know what I need to do? I need to create that order once again. So let's go back. It's probably good repetition anyway. 17 December, we're going to sell the 66.50. We're going to buy the 66.30, $2 credit. Click on confirm and send, read through the order, make sure that we're aware of that. I'm going to put this back in my weekly options group. We'll click on send and we'll fire that order off, and we got it for $2. So we brought in $2. Now we're going to look at closing this trade down next Wednesday, come what may, because we want to capitalize on rapid time decay and theoretically the market continuing to move higher. So we sold it for $2. We're going to look at buying it back for whatever we can buy it back for a week from now. That's the 14-7 strategy. Now, a couple of you have asked the question in terms of this trade or in terms of this strategy, How have we been doing in this strategy? So in general terms, without printing this out and doing a full accounting, in general terms, we have been more successful than not. We've taken a couple of maximum losses, but very few. We've taken some small losses, but not as many as we've had winning trades. But past performance is no guarantee of future results. So keep that in mind. And if markets change, if that trend direction changes, that's where sometimes a strategy like this can see some challenges. So beware of that. All right, so that's our 14-7 strategy, kind of keeping that in mind. All right. Oh, I want to answer JD's question real quick, too. Let's just do that again really quick. 66.50 and 66.30. And if we confirm and send, here's the buying power impact. 17.95. 1,795 on that spread. All right. Okay. So it's, and you can see the volatility has increased a little bit here. So it would have been 1,800. This is a long vertical spread, and these are European style, so we don't have early assignment risk. Long vertical spread, if this goes in the money, I'm sorry, short vertical spread. We don't have that early assignment risk. This is a short vertical spread. So we want this to expire worthless or get closer to being worthless at expiration. All right. So that's how we put that trade together. That's the 14-7. All right, let's come back over here and let's go to our monitor tab for just a second. Let's just make sure that, yeah, that's still kind of hanging out there. We've still got those orders there. I don't know that that's going to fill. So let this be a lesson, just a kind of a learning moment, that sometimes when you hold spreads till expiration or close to expiration, doesn't matter if it's in the index, it doesn't matter if it's in an equity, that you might have challenges getting out of that trade on the day of expiration, which is one of the reasons why 0 days till expiration trades carry with them some significant challenges. And we've talked a little bit about that before. All right. All right, the next thing I want to do really quickly is I want to go back to the chart of, and I'm going to bring this, my single grid here real quick. And we're going to put on here the VIX, V-I-X. This is the volatility index. And I want to pop into this discussion my RSI, and we'll click on apply and OK. So one of the things that we've seen is that the RSI is kind of nestling itself down in this lower portion of the range. It's kind of staying back down in that area. Notice that the RSI, now RSI, that particular index, even though the VIX itself is not a tradable instrument, the RSI is going to look at where prices are relative to their highs and lows. So it's going to give us some valuable information, momentum information. Momentum is fairly low. This is kind of sitting at that low end of the range here. My thought was, what if the market starts to pull back and we start to see a rise in implied volatility? That can happen very, very quickly, right? That can happen very, very quickly. So if we think about this and how we might do this, let's look at maybe taking a possible long vertical spread approach to trading an upward movement in the VIX, more directional. So while we're thinking about that, let me answer Alfonso's question. So we take max theoretical loss, about 4 max losses. So that puts us at about a loss on that side of about 8,000. But if week after week we're getting, 170, 180, and we're starting to pick that up on an ongoing basis, overall, this strategy at the moment, the 14-7 strategy, can be profitable. And again, not, in that particular case, and I'm not making anything promissory, nothing else in terms of recommendation. I'm just simply saying a strategy like that has a smaller potential gain against a larger loss is an approach that many traders take on a regular basis without even thinking about it. Because you think about what you might gain on a long call op, or just a long call or a long put against the amount of the cost of the trade. You might think about what you might make on buying a stock versus what it might do if it were to go to zero. So that type of strategy requires us to have more winning trades than we have losing trades. And so generally, this is a strategy that has been providing more winning trades. It does not mean that that won't change. It doesn't mean that that's always the case. There is always that possibility that things change. And when things change, we look at changing then the approach to the system or the instrument that we use to trade that approach. All right, so let's take the VIX here. And we're going to go to the trade tab for the VIX. And we're going to go VIX. And though we cannot trade the VIX itself, right? We cannot trade the VIX itself. We can trade the options on the VIX. Now, here's what I know. Is that we've got a Fed meeting coming up. We've got end of the year volatility. We've got delayed economic data coming out of the government. So there is likely to be some movement here in volatility. And as we start to look at this, I'm going to look out to, say, for instance, the 17 December expiration, or maybe even the 24 December expiration. I think I'm going to go to the 24 December expiration in this case, Christmas Eve, because I like that. And what we're going to do is we're going to look at buying a long vertical spread. And when we use a long vertical spread, we have some directionality to it. We want to see directional price movement. So what I'm going to do here in this particular case is, because I have an expectation that implied volatility is likely to go higher. And if implied volatility goes higher, that's going to do two things. One, if I'm trading implied volatility increasing directionally, I get that bang. If I am trading a long vertical spread that is sensitive to positive vega and implied volatility goes up, I get a second bang for the buck here in that particular case. So here's what I'm going to do. This is sitting right about 16, just about the 15 handle, top of the 15 handle, 16 handle. I'm going to go one strike in the money in this particular case on the index. So I'm going to buy the 15 strike call option. And we could just leave it right there at that long call option. Click on confirm and send. There is the possibility of making money. That's a max loss of $3.45 times 100 units in this case, since it's the VIX, it's not exactly shares necessarily, but $345 is our max theoretical loss if we just go long a call on the VIX, which we could do. But I think we can do a little bit better here if we come down and we say, all right, I want some directional movement. I want to reduce the cost of that trade a little bit. What if I come out and I sell, because I know that my average for implied volatility is up around the 19. So even if the implied volatility index, if the VIX moved up to its average and didn't make a big spike, it may go back up to about the 19 range. So I'm going to sell the 19 call, and I'm going to create a vertical spread. So this is a $4 wide vertical spread, 15 to 19. And I'm buying that vertical spread for $2.11, a little bit more, 11 cents more than half the width of the spread. So I click on confirm and send. I stand to make in this trade $189, theoretically. Stand to lose in the trade $211, theoretically. That would be if the VIX at expiration was at or below the 15 handle. We're going into the end of the year. It's very likely, not guaranteed, very likely that the VIX is going to move up, especially given some of the circumstances that are there. So this is a strategy that's designed to take advantage of that. Now, the VIX options that we're looking at here are European style. So there's not that early assignment risk, but even if there was, early assignment in a long vertical spread often may result in max theoretical gains. So we're going to put this into our index options group. We're going to read through this order, and we're going to click on send, and we're going to fire that order off. And we'll see if that order fills for us here. But this is simply a long vertical spread. Our expectation is that the VIX just rises. So that's something that, yeah, you're right. Cindy, I know, I keep going back to the well, right? And Cindy reminds me that this VIX trade will probably work, as the last two ones I did not work out. The VIX didn't pop. We didn't get that move to the upside. But I wanted to kind of, play this likelihood in this scenario. So we'll see if that fills. We'll kind of keep that hanging out there. And we would think so, right, JDM, that the Fed cuts, wouldn't that make the VIX go down even more? You'd like to think so, but last time it went up. All right, so let's do this. Now, the next thing I want to do, the kind of wrapping into the last part of this, is I want to go back to our portfolio here. And I want to say, all right, fine, let's do this. Let's take a look at our stock portfolio. And I've got a number of stocks in this portfolio. I'm going to unbeta weight this at the moment. And I've got a delta column here in this watch list or this portfolio. So I am long 5,960 individual deltas, right? 5,960 individual deltas. That's all of these different positions with their own individual deltas. If I beta weight this portfolio to the XSP, the mini SPX index options, the XSP, then I come down here and I look at and see what my new delta number is. 1,548. I still want to be long. I mean, I still want long exposure here. But remember I said that there's that possibility that we might see the market go down a little bit? So I want to offset some of that long exposure. So I want to take out of this equation some of that long exposure. A couple of different ways that we can do this, and we've done this before. We could buy an SPX put. We could buy an XSP put. We could sell an XSP call spread. So a lot of different things that we could go about doing. But, here's the thing. All of those have their drawbacks. If we were to go to the trade tab, let's go to the trade tab here for XSP. If we were to buy a put on the XSP and we were to buy this outright and we were to go out, say, for instance, once again to let's go out to the 24 December expiration here, or even the 26th. Let's go to the 26th December expiration. And we were to buy a put on the XSP. I don't need 120 strikes at the moment. Let's go to 50. Nope, not 150, just 50 strikes. If I were to go out and I were to buy a put option on the XSP, that defines the level at which my protection starts to make sense, right? So if we were to go down here and say, hey, for instance, the 683 mark, if I were to buy that put option, if I change my layout to Delta, Theta, and Vega, has about 42 cents of negative delta. So that's going to take out, one contract's going to take out about 42 deltas. But that contract's going to be fairly expensive in terms of the cost to provide that hedge, $735 per contract. That could potentially be a sunk cost if we're going to hedge with a long put. So we might think, oh, call spread, but then we don't get the same delta punch. We don't get the same delta reduction by using a call spread. So what if we were to do something like this? And I'll kind of show you what I want to do here. The other thing to think about here is this has a fairly high rate of time decay. It is also fairly delta or Vega sensitive, volatility sensitive, but it's that time decay that's working against the cost of that vertical or this long option that makes it maybe not the most opportune hedging instrument because it's decaying away and it's a big cost. So what if we were to do something like this? What if we were to say, all right, fine, I'm going to change my layout once again back to intrinsic and extrinsic. And we're going to create a back ratio spread, Brent talked about this earlier in his webcast today, in that Managing an Options Portfolio webcast. So we're going to create a back ratio spread, but we're going to create a back ratio spread in a way where we take out that Vega function, or excuse me, not the Vega function, the theta function, so that we take away that kind of time decay element of the trade, and we give ourselves still some directional sensitivity here, some delta sensitivity. So what I'm going to do is I'm going to look at selling a put option. Yeah, we're going to sell a put option here in this particular case to begin this strategy. And in fact, I'm going to go right about the at the money strike, right about that 685 strike. And I'm going to come over here and I'm going to look at this extrinsic number, and I'm going to say that extrinsic number is about $8 of extrinsic value. So that means if I'm going to sell this one, if I were to just leave it right there and sell that put option, whoops, let's do this, delete, let's go right here, sell the 685 put option. We've got a pretty substantial max loss if that index goes up. The likelihood, though, that the index is going to go to zero, pretty low, and if it does, we've got bigger things to worry about. Nevertheless, that's going to be a fairly pricey possible loss, and it increases our buying power effect impact. So what if we did this, however? We're gonna sell that one. We know that it's got about $8 of extrinsic value. What if I come down here and I find an option, say for instance the 693, that has about $4 of extrinsic value, about half that extrinsic value of the one that we're selling. And that's going to be this one right here. And we're going to buy two of those, 1 and 2. Now, this is going to be more expensive on the outset, but it's not going to suffer from as much time decay. So think about this. Here's what we've got. If we click on confirm and send here, we've got a potential maximum profit. Now, what we've done is we've shifted this directional sensitivity. We've given ourselves the opportunity to profit if the index goes down. We've reduced our max theoretical loss, and we've reduced our buying power impact to the tune of what two long, less delta reducing contracts would be. So let's talk about the Greeks here, the net Greeks in this particular strategy. This strategy, by putting together this back ratio spread, should have a greater delta impact on our portfolio than one of those contracts by itself, one of the long put contracts by itself, and it reduces the theta sensitivity. So I'm going to change my layout again here to delta theta vega. Now, here's where we're going to have to do a little bit of math. Okay, so we bought which one did we buy? I forgot already. We're buying the 693, right? And we are two of those, the 693, and we are selling the 685. So 693, if we take a look at that delta, so 2 times that delta, that's 120, that's 120 deltas. So that's minus 120, right? That's taking out 120 deltas. If we now sold the 680, what did we do? Sell the 685. Now we're taking out 45 deltas. So 120 minus 45 leaves us with, 120 minus 45 leaves us with 75 long deltas. 75 long deltas. So if we're taking out 75 long deltas on this trade, what that does now for us is it gives us that opportunity to reduce some of the sensitivity of our portfolio overall to movement of the SPX or the XSP to the downside. So let's see what this looks like. I'm just doing some calculations there. Let's see if that works in our favor in this case. All right. So let's bring our trade up. And before we do that, before we send this off, I want to right click and send this to the Analyze tab and see what this looks like. We're not on the VIX, we're on XSP. And I want to take the one that I was looking at earlier off. So this is what's sometimes referred to as the zero extrinsic back ratio spread, or in other words, a zebra trade. Directional sensitivity is to the downside. Max theoretical gain is if on the spread itself, if the price goes, or excuse me, max loss is if the price goes up, but that max loss is capped. So theoretical max gain is all the way to zero, but this, in this particular case, gives us some delta reduction, but takes out that time decay sensitivity. Because if we go back to our trade tab and we look at our net Greeks here for time decay, we're left with basically a push when it comes to time decay because we sold all of that extrinsic value. Same thing with implied volatility. It becomes somewhat of a push with implied volatility. So if we fire this order off, and let's see if we can get this filled and see what this looks like. We're going to go to confirm and send. We're going to read through this order, and we're going to put this in our stocks group and click on read through the order, make sure that we're aware of any transaction costs, make sure that we're aware of any alerts. Click on send, and we fire that order off. Now we've got that spread, that zero extrinsic. So we're long 2 puts, short 1 put, and we go back to our monitor tab, and you can see how much that has reduced our delta sensitivity. So if I wanted to reduce my delta sensitivity even a little bit more, I could do 2 contracts or 2 of those back ratio spreads, and I've reduced the sensitivity of my portfolio, but I've eliminated the downside potential of that time decay in that spread for the most part. I've kind of washed that time decay out of that spread trade. So a little bit more expensive, but again, for the purpose of this scenario here, this is another way that we could use index options as a means to hedge our portfolio. We can put them together in spreads, even ratio spreads like this is, which is a 2-to-1 back ratio spread. We're buying 2, selling 1, but we're doing it in a way that we take out that extrinsic value component and eliminating that, mitigating is a better way to put it, mitigating the time decay component here. All right. I want to give you some resources to help you kind of continue your learning on this idea. So here's what we're going to do. I'm going to pop you over here to, first of all, the Schwab coaching page. So for those of you that are just joining us, that are brand new, that have not experienced this, schwab.com/coaching is the landing page for our Schwab coaching resources. Live webcasts, all of these 30 plus hours of webcasts that we teach on a regular basis every week. That's all right here. You can access those. Here's the one that we're in right now, Trading Index Options. Coming up next is Scott Thompson teaching stock investing for beginners. But then you've also got access to the calendar for our in-person events. Barb and I are going to be in Houston next weekend. And then we're going to be in Miami just before Christmas. Then after Christmas, after the first of the year, we're going to be in Dallas for a technical analysis and option strategies workshop. We're going to be in Seattle, Bellevue in January as well. We've got an event coming up in Sacramento for those of you in the Central Valley that have been asking for us to come to Northern California and the Central Valley. We're coming to Sacramento. Then we're going to be down in San Diego and then in Atlanta. And I know there are some of you in here that have been asking this for a while. Look at this one right here. April 17th, Boston, Massachusetts. That's coming up. We will be there teaching technical analysis and option strategies. I'm excited for that one. That one's going to be fun. And then if you want to learn more about these particular strategies, come on over here to the Trader Talks webcast page. I have one ask for you, and that is you click on subscribe. That's it. Click on that subscribe button. Follow us here on YouTube, but type in this right here, beta. Beta? So type in beta, and you're going to get Brent Morris talking about beta weighting. You're going to get me talking about beta weighting. You're going to get Connie talking about it. charting beta, divorce portfolio protection, relative cost of portfolio protection, lots of different ways that you can use beta. And then the other thing I'm going to have you do is come right over here and type in ZEBRA, zebra. Here's Brent Morris talking about zebras. Here's me talking about zebras. Brent Morris, Connie, Rachel talking about zebras. Brent Moore's, lots of people talking about zebra trades. So you get those resources to be able to learn that particular strategy. So with that said, my thanks to Barb Armstrong for helping out today. My thanks to all of you for being here, for our great production staff and our reviewers. Have a great rest of your day and a great week. We'll see you again next Wednesday. Take care, everybody. Bye-bye.